You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back. It is time to dance once again on Education Wednesday. That means it's time for everyone's favorite educational program out there. Yes, it is time for Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Reminding you out there, if you like what you hear, you're one of our many on-demand listeners. It takes a couple seconds, head out over to whatever platform you're listening to. If they allow reviews, then have at it and leave a nice little review over there. It does help the legion, the litany, the plethora of new people who are continuing to discover this program week in, week out over there. You could argue these reviews these days more important than way back in the primordial ooze days when Dan and I first started this show. So if you like what you hear, if you are so inclined. If you're not, then send your hate mail to Dan, care of Dan at MTM. He loves that stuff over there. And of course, if you want to join us live, join all the other shows we do throughout the week live, get exclusive shows like the Pro Q&A yesterday, as well as Options Oddities on Friday, the giveaways, all sorts of other cool stuff. Join the cool cats from all across the globe now. They're really in the secret club. Theoptionsinsider.com/secret club is the place to go. And of course, however you listen, if it's live, if it's after the fact, whatever, however you get the content, keep those questions coming. We do love to hear from all of you folks out there, and especially for this show. It is funny. You folks are not reticent. I really don't need to remind you to send questions in, but I kind of like to do it anyway because we do love to see what's on your brains out there. And you got a very specific thing on the brain this week. We're going to get to that in a second. First, let me welcome on my compatriot, my partner in options educational crime, my fellow drill instructor here on the Options Bootcamp Proving Ground, none other than the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker Mentoring, a.k.a. as well as the author of one or two options-oriented tomes. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
It is good to be here, Mark. Good to be back as always.
It is good to be back. And this is usually the top of the show where I remind people to leave a review. So we like to show some of the nice 5-star reviews we've gotten, Dan. And as our producers were aggregating those for this week, they came across some other fun stuff, including this just came out yesterday. I think a site called FeedSpot ranking what they put their top best 15 options trading podcasts. And Dan, take a guess. What is number one, sir?
Is it really? Is it us?
Actually, no, it's not you. It's the Option Block Show. It's one of our other shows on our network. It's number one. Nice. But you're, and then number 2 or 3 is Twifo, This Week in Futures Options. And then it's you, Dan. You're actually number 4. But still, you're on the top there. You beat Options Action from CNBC. So that should give you a warm fuzzy, shouldn't it?
Oh, well, I guess that's good.
You got to beat those scrubs from CNBC. I mean, what do they know about options, right? Hey, I got something else to cheer you up. As they were aggregating all this, they went to a site called Listen Score, which analyzed, Dan, 2,788,526 podcasts around the globe. And they said that you, Dan, and Options Bootcamp in the top 2% of global podcasts. What say you?
Top 2%. I've always thought of myself more as a 1%er. So I gotta call those guys.
We got to get you up there. But yeah, top 2% of the globe. That's nothing to sneeze at, sir. There's some big heavy hitters in the podcast world these days. So yeah, I think if I were you, I'd be a little bit happier. Even though I get it, you're mad you lost to the option block. It's a popular show. People like it. And people like futures options. So hey, you're number 4. But you're number 3 in our hearts, Dan. So that should make you feel better. As we keep on rolling right on into basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, everybody, welcome to basic training, where we break down a basic options concept or technique or strategy and explain a little bit more about it, how you can utilize it in your portfolios, all that fun stuff, and a whole bunch more. And today's topic, in fact, looks like a lot of you have a topic like this on the brain, so we thought we'd revisit it again. This one comes from, in particular, the first question that kind of got the ball rolling was from Joe T. He says, I'm confused about Delta. I get that it's how much you need to hedge, but is Delta really the probability of an option expiring in the money? I've read different things on the subject, so I'm coming to the gurus. That's us, Dan. He's coming to the gurus to sort it out. Yeah, we had a similar question last week, I believe, on the huddle with Brian Over. People obviously have Delta on the brain. When we get to the listener mail a little bit later, you'll see they have some more Delta on the brain. So we know a lot of you folks are new to the show. We see the numbers, so we know a lot of you have joined in the last year, sometimes in the last 6 months, 3 months, sometimes even. So sometimes you don't do a deep dive into the show before you start writing in. I get it. Different platforms gate things different ways. Sometimes it's a little bit harder to find stuff. If you do want to go do a deeper dive into Delta in our archives, we do have you covered there, listeners. The most recent Delta deep dive we did was about a year ago, a little less. It was on the episode 128, entitled, appropriately enough, Delta Deep Dive, on March 24th of last year, 2021. We also did an episode 112 on Can Your Deltas Bleed? It's a fun one. Check that one out. That was from November 11th of 2020. We touched on it again in our 100th episode spectacular back on August 19th of 2020. And we talked about spread deltas and things on Options Bootcamp episode 76. That was from June 25th of 2019. And back on episode 65 from May 5th of 2017, we revisited Delta there as well. So there's multiple deep dives on Delta. Just make sure you do a little scrolling. If you can't find those for whatever reason on whatever platform you're listening to this on, you can always find them on our website or on our mobile app. Everything is on every show we've ever released on the past 15 plus years is all there for your educational and listening pleasure. But Dan, let's get to it, because obviously a lot of people have Delta on the brain yet again. Understandable. It's kind of the primary Greek for new players to the world of options. Dan, you're the guy who literally wrote the book on the Greeks. What do you have to say for, what was the name here? It was Joe T. He wants to know, is Delta really the probability of an option expiring in the money, sir?
Well, that is a great question. And the answer is, I'm going to say the answer is yes and no. Technically, it's no, but we've got a lot to talk about as far as the yes part of that answer.
Let's get into the yes part then. Because Dan, I know, as I did, and I think Brian even brought up this analogy, and he wasn't even on the SIBO, so he encountered it enough as well. When you first walked on the trading floor of the SIBO back in the go-go.com crazy time 90s, late 90s really, when, everyone was fighting to get down, literally fighting to get on the floor of the SIBO. It was a 3+ month wait list for the privilege of paying 20, 25 grand a month to rent a seat down there. That was the time when you walked into that maelstrom, that cacophony of madness. That was the place where I was really first introduced to the lingo of Delta as a shorthand for probability. Obviously, I knew it from the Black-Scholes and reading Natenberg and learning about it in my educational stuff. But I heard it firsthand down there. When you go down, they start talking to traders. They would just throw Delta into their conversation, into their lingo, and it was just always a shorthand for probability. You'd say, hey, what's your, you're going to be going to series later. I'm about a 50 delta. That means they didn't know. They're 50-50. You want to go out to dinner or get drinks later? Oh, I don't know. I'm about a 70 delta. That means they're probably leaning towards yes. It's just something that worked its way and ingrained itself into the trading vernacular. In fact, to this day, if I encounter someone who used to be a former SIBO person, there is probably a good 30 delta, that at least maybe 50 delta, that they're going to work delta into the conversation because it just pops up. It's ingrained there. So, Dan, I'm sure you encountered this as well. It was thrown around and bandied about as if it was the same thing, as if delta and probability were the same, sir. Would you agree?
Oh, yeah, absolutely. I mean, I still to this day will use that when I'm talking to people in the industry. 100%. Every single trader every single option trader that I've ever met uses delta in that regard, totally as part of their typical nomenclature.
All right, but we're telling them that it's not really the case. So let's get into that a little bit there, because you're right, Dan. It is not really the case. If you go out there right now and let's say you buy a call and it has a 71 delta, it's pretty meaty, it's pretty beefy. That does not mean you have an exactly 71% chance of that option expiring in the money. But Dan, like I said, you wrote the chapter on delta. So what say you for that for the folks who are still a little bit confused?
Yeah, there's 4 definitions of delta. I do list that as one of them. I call that the trader's definition with a little asterisk and a little footnote that says, warning, 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 danger, Will Robinson. This is not actually mathematically accurate. So there's kind of a number of things that make it not mathematically accurate. First of all, it was really never intended to be used that way, but traders kind of came to the realization that it kind of works as a nice little rule of thumb proxy. So that's thing number one, is that just mathematically, it's not supposed to really represent that. It just kind of comes close in concept. Thing number two is that, and this is always such a fun conversation to have, delta is predicated in part by volatility. That's one of the calculations that goes, at least in a roundabout sort of way, into determining the delta. And the thing is that implied volatility is arguably always wrong. And when I say arguably, it's because we could argue about it. I would just, shut the person down that I was arguing with and tell them that they're absolutely wrong. But I would certainly go as far as saying that implied volatility is indeed always wrong. So if implied volatility is wrong, delta is wrong. And delta is not really supposed to be used that way anyway. So, that kind of negates that. Now, all that being said, it sure is nice to have a little bit of a rule of thumb as far as, just guiding the probability of success in a trade. And if you think about the other definitions of delta, which is, I think, the most relevant definition of delta here, the hedger's definition, is it's the equivalent of the number of shares in the underlying. You can kind of if you sit there and really ponder it for a while, and I don't know if we need to go into the logic progression during the show, but if you really think and ponder it for a while, you can bring yourself to being like, oh, okay, so I can see how that's the probability of it being in the money. So that being said, it does become a really useful tool. It can be used as a rule of thumb, as long as you appreciate the fact that it has its limitations and it is just only a rule of thumb.
Dan, you're killing me. You're shattering my worldview. How dare you say implied volatility is always wrong, sir? You're crushing me. You're killing me here. I don't know if I can go on with the show, sir. I'm so distraught.
Well, I'll tell you what, Mark. I'll just let you believe that, and I'll just take the other side of all your trade.
So I shouldn't be buying all this vol just nonstop, even just heading into expiration, just overpaying, 20, 30% extra premium for that. That's not the way to make all my money all day long, sir?
Generally speaking, no.
Nick, you're killing me here. I got to go back and rethink everything we've talked about on the show for 100+ episodes here now. But Dan's right. When you're talking about delta, it's important, really, if you're still confused by this stuff. First off, if you want to dive into the mathematical probabilities for yourself, it's easy to do that. If you go type delta and probability into any browser, you'll start seeing different ways to calculate. You'll see, of course, the old Black-Scholes model, which is what Dan is talking about, by using the implied volatility to get into your delta. You can do things like binomial trees and other things. And once you start seeing these different pricing models and how they start, A, pricing options a little bit differently, and B, also implying different probabilities through them, you can start to see the chinks in the armor a little bit there. So I encourage you, if you want to go a little bit deeper into that, that is definitely something that is worth doing. Again, if you haven't done so already, go back and read our number one recommended reading book as well, which is, of course, Natenberg, Option Volatility and Price, and they get into it a bit there as well. But a few shorthand rules of thumb, if you're kind of just confused by this and you want to know a basic way to approach this. At the end of the day, when you're looking at the at-the-money option, right, which is where a lot of you folks are trading these days, that's going to have a delta of a roughly 50, right? That's going to be effectively your coin flip because it's bouncing around. The at-the-money's vacillating around. If it's in a meme stock, it's bouncing around even faster. And so that's going, you can't predict with any certainty whether that's going to be in the money or out of the money because it's ticking in the money and out of the money every second because the underlying is moving around. So that's going to have your delta of 50. That's pretty much your coin flip probability right there. And then as you start getting in the money more, you're going to start approaching that 100 level, or 1 if you like to use the delta 1 nomenclature instead. So it's going to be somewhere between 50 and 100 as you get in the money. You start going the other way, you start getting out of the money. It's going to be somewhere between 50 and 0. And the farther you get out of the money, the closer it's going to get to 0. Nothing's ever really a 0 probability, right? There's always a fraction of a percent of a chance that something crazy could happen. So you're never really going to have a 0 delta, but you can effectively have a 0 delta on some very far out of the money options. So that's a basic rule of thumb that you can keep in mind if you're looking at delta, trying to figure it out. And just keep in mind, too, if you see, like I said, a 73 delta on your call, doesn't mean you have an exact 73% chance of that option expiring in the money. But as a good ballpark estimate for what the probability of that option expiring in the money is, delta is an excellent ballpark estimate for that. So it has that use case, and it's something you can rely on for that. Outside of any other factors, if you can't get any other analysis and you just need to rely on the options chain and what your broker is telling you there, the delta is a good shorthand for that. A few other caveats to keep in mind you're looking at delta. First off, delta, it's obviously the probability of the option expiring in the money. So this is assuming you hold that position all the way through to expiration, which is something that the vast majority of options traders do not do. So already that definition of delta is becoming suspect for you because you're probably not going to hold this thing to expiration. You're probably going to take it off earlier. So you don't really care if it expires in the money. You're more interested in perhaps if it touches that strike sometime during the lifespan of that option. That's kind of a separate discussion, which maybe we can have on a future show. There are some people out there who've kind of done alternate probabilities for the probability of touching a strike during the lifespan of an option. Like I said, that could be more relevant for a lot of you out there because once you touch a strike, then certain things could start to happen. You may want to roll, for example, if you're short a covered call and you hit the strike and cross over it, that may trigger you wanting to roll, or some other type of adjustment. If you have short puts and you break through the strike to the downside, you may want to roll those down. So there's a lot of other adjustments you might do that could be triggered by that wouldn't be triggered if it just expires in the money. So a couple of different things to think about. Dan, have you ever encountered this probability of touching the strike? And do you have any thoughts on its utility versus the probability of expiring in the money for most options traders?
Yeah, like those are two different things. And to be fair and to be clear, the probability of touching isn't really all that mathematically valid either, because there's actually one more thing that's even more important that sort of somewhat negates both of those. Again, I use it as a rule of thumb. I use it in my vernacular. But the other thing that really negates both of those, probability of touching and probability expiring in the money, is the fact that it completely disregards any factors at play, any fundamental analysis or any technical analysis or even any volatility analysis. Because, I mean, if there's just like massive support at like a par level at $100, stock's trading at 110, there's massive support at 100. And those par levels are always massive support anyway. And the 200-day moving average is there. It's just like a freaking brick floor. Like it would take a lot of selling for the stock to break through there. If the delta is 30 on those puts, there's not a 70% chance of those staying out of the money. Like there's way more than, it completely negates like logic and trading analysis. Or if there's just like massive fundamental information, like I was looking at Lockheed Martin, right? Because that's sort of in play with this whole Ukraine craziness and such, right? So if I'm looking at the let's see here, the March 23rd 60 calls. Let's see here. It's at 389. So the 400 calls, there's a 32% chance of that being in the money. I mean, it's probably somewhat higher than 32%. I mean, it's not more than 50%, obviously, because they're out of the money currently. But I mean, that's just like clearly and obviously low figure. And if you look at some of the puts too, the 365 puts have an 18 delta. That means they have an 18% chance of being in the money. It's probably somewhat less than that. So, I mean, it just sort of, it's like any rule of thumb ends up being nice to have, but a gross oversimplification in a business that's as mathematical as trading options.
Yeah, the truth is, at the end of the day, there really is no completely 100% airtight probability that encompasses every single factor that you may want to look at there. Dan's talking about technical analysis. There's fundamental analysis. There's what orders are lurking in the book to keep things moving around. There's your implied volatility. There's all the other aspects that go into analyzing the probability of an option expiring in the money. So if you just want to lean on Delta as a kind of a rough approximation of what you should be expecting, then it certainly will function in that use case. And for the vast majority of you, that's really all you need out there. So great questions about Delta. I think we have some more about Delta coming from you folks. You guys got Delta on the brain this week, so let's keep rolling right on into the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. Before we get into more of your Delta madness, let's look really quickly. Let's pay off our poll question from last week. We asked you folks, it was right after coming on the heels of the Super Bowl. We said, hey, according to the Super Bowl indicator, the score was only 43 points. That's kind of low. So that foreshadows a weak year for the S&P 500. Are you guys buying into that indicator? Quite simply, what are you guys putting on right now in terms of your broad S&P exposure? Give you four choices. You're just hanging out long, SPY, or SPX. Your long SPY calls, or going the old stock substitution method, or your long SPY, but you got to put in your back pocket, or the infamous other. And looks like 43.5% of you may be buying what that Super Bowl indicator is selling because you're long SPY still, but you got that put in your back pocket for a rainy day. So I can't really fault you given everything we're seeing out there right now. I'm not saying you really believe in the Super Bowl indicator, but it's clear you have a little bit of trepidation with these markets. And again, who could fault you? 43.5% of you right now saying, hey, I got that put for a rainy day. And 21, almost 22% of you saying you're going long SPY calls or stock substitution route. And only 17.5% of you saying you're still long SPY, just straight up long SPY or SPX. So Dan, does that surprise you at all? That nearly half of our audience, they're long SPY, but they got some protection for a rainy day, sir.
No, I mean, that's a nice little conservative way of playing that for sure. So that's no surprise, especially because our listeners are smarter than the average bear. So no surprise there, man.
And certainly sexier as well. And just in general, more compelling people, would you say?
Indeed.
Than the average person out there. They're definitely in the top 2% of humans. We've discovered that. You can hold yourself up there. You're in the top 2% of humanity, listener. Let's go on out to Alan. He's definitely the top 2% of humanity. Alan says, should I really be paying attention to my deltas if I'm primarily trading long vertical call spreads in single names like Hoods and Palantir and Rocket? Is a spread delta really a meaningful metric versus outright options delta? So, Dan, this goes back to what I was just talking about. People have delta on the brain. Obviously, listeners, if you're going out and buying, like I said before, that 71 delta, that's your outright delta for a call. If you're doing verticals, though, you're buying one and selling the other. So if you buy that 71 delta call, then you sell, let's say, a 20 delta call farther out of the money against it. Now your delta is down to 51. And so Alan is asking, Dan, is it meaningful? Should I even pay attention to my spread deltas or delta as a whole if I'm just loading up on verticals in your, looks like some meme names, sir?
Well, should you pay attention to delta? Yes. But as far as there's a couple of things to unpack here. As far as in terms of probability of expiring in the money or blah, 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 blah. I mean, first of all, even as a rule of thumb, you wouldn't use the spread delta. You would use, like, in terms of like buying a debit call spread, what you would probably do is use the delta of that short call, the higher strike call in your spread, because that's where you want the stock to get to. So you literally want that call to become in the money to maximize the value of your spread. So you would only look at that delta, not the spreads delta. But that said, as far as the spread delta itself, you do want to look at it because that is going to tell you what your profit and loss will be as the stock goes higher or lower. The only problem with these meme stocks and using delta the proper way, like the other three definitions besides probability of success, is that there's a lot of other factors at play. That doesn't negate the use of delta, but it makes the other factors at play very important to weave in as well. Like with stocks like Rocket and maybe even Palantir. I own some of the shares of Palantir, but Palantir is a little bit different, I think, than Rocket because you do have a little bit of skew to the call side, a little bit, not a ton, a little bit. But I think with both of those, certainly with Rocket, if the stock goes up, implied volatility is likely to go higher. So that's going to kind of change your delta a little bit. It's going to add more value to your spread as the stock goes higher, independent of delta. And then, of course, the massive gamma and the massive moves that can potentially be possible. We haven't seen any of those in Palantir or Rocket in a long time. But I mean, if it just blasts 50% higher in a day, then there's a little bit of merit to saying, doesn't matter what the delta, I hit my maximum profit, boom, wham, bam, thank you, man.
All right, let's keep going. You got more delta in you, Dan, because they got more delta coming at us here. This one comes from Eric. He sent this into Options Playbook Radio. We talked about this on our 400 episode spectacular, but I know there's a lot of you who just mainline bootcamp, and I wanted to bring this up here too, A, because it dovetails nicely with the conversation we're having, and B, because he makes some, I guess you can call them dubious assumptions about how assignment works, and I thought it was good to dispel those here on this program as well. So Eric has a two-parter. He says, first, I've been studying options for a few months. I have two questions I was hoping you could help with. I'm primarily interested in covered calls on long equity or ETF positions. I want to generate some moderate income off those to reinvest. My preference in this case would not to be assigned, but if it happens, it's not the end of the world. So far, my assumption is that I need to have a starting delta on selling a covered call of around 20. He even puts here in parentheses, 20% chance of assignment. So he's using the old delta as a probability shorthand as well. He says that would also depend on some technical analysis, et cetera. I may bump that up or down a little bit based on technical analysis. But as a thought, is a 20 delta a good starting point for this covered call strategy? And on the second part of his question, he says, I'm curious on the assignment if the expiration price falls between the strike and the buyer's break-even point For example, I sell the call at the 70 strike. It closes at 72 on the day to expiration. Let's assume the buyer paid $3 for that call. His break even is 73. My thoughts are it would be highly rare to get assigned if the expiration price falls between the strike and the buyer's break even. He's probably closing that option instead of assignment. Would that be an accurate assumption? All right, a lot to unpack here. A good question here. This is Eric Dyer. First off, let's do the second part first, because that's the easiest. The answer to that is no, Eric, and no one should assume. You shouldn't think of trades in that sense. Oh, I wonder what this person's break even is, because that influences what happens to my trade. No, in terms of options, we've talked about this before. There is that automatic exercise threshold. It used to be a nickel back in the day. OCC has shortened it now to a penny. So if your option, or I should say the stock, expires 1 cent beyond your strike, if it's a call, 1 cent below it, if it's a put, those options will be exercised automatically. In fact, someone has to actually contact their broker and issue contra exercise orders if they don't want that to happen. So it's exceedingly unlikely that that will happen. It can happen. There are times you could skate. It has happened, but it's very rare. And so if you're looking at this and trying to assume that someone has a higher break even and you won't be assigned on those, that's not going to happen. If your option expires a penny in the money, count on it being exercised automatically and you being assigned at the end of the day. So let's just dispel that second assumption now. Now, Dan, back to the first part of his question, which is germane to our conversation today, which is using a 20 delta as a starting point for a covered call strategy. What say you to that, sir?
Well, I'm not really a big fan of using deltas to set strike price levels in any option strategy. First of all, as aforementioned, it's not accurate. Second of all, it's completely arbitrary anyway. If there's a 20% or a 30% chance or a 10% chance, the price of the option reflects that. Like, the whole purpose of the options pricing model is to 100% guarantee that no one strike is better or worse for selling or buying than any other ones. The greater the probability of being in the money, the higher the price, and the lower the probability of being in the money, the lower the price. So, okay, great. You have only a 20% chance of assignment, but you're bringing in less premium than if you had a 25% chance of assignment. So it's a very popular and common way of selecting strikes, but it has literally no merit at all. Like, it just baffles me why some people do it that way. It just doesn't make any sense. Like, if you understand how the option pricing model works, you would never select your strikes based on delta. I don't know, it's just illogical.
So what would you recommend for him instead? Would you recommend some sort of percent out of the money, a premium level? What is your better starting point for Eric?
Well, there's a couple of things. Like, our MTM Smart Income system is all about covered calls, cash secured puts, and I personally trade these every single day. So there's a couple of metrics that I use. I mean, first of all, I use resistance levels in a lot of cases because that actually is relevant. That's where it's been shown that that's where the sell orders are. There's a better chance than not that the stock will bounce back lower when it gets to resistance. That's like literally something that holds the stock down. So at or above resistance would be a smart level to set a covered call strike. Another thing is, like, I'll do it very serially, meaning like in spiders and often in Apple, I'll just keep rolling. I'll just, sell the call. It's expiration day, buy it back for a nickel, sell another call. Okay, buy it back for 3 cents, sell another call the next week out or something. And so if you do that, you're not really looking at resistance anymore. But you do want to look at a couple of things. You want to make sure that you're getting enough premium. Like, if you're only collecting like 0.2%, and you're limiting your upside and not providing barely any downside protection, it just doesn't make sense from a risk reward and opportunity cost standpoint. I don't know. I can go on and on all day. Like, we have literally a whole massive 6 or 7 hour course on that.
You got somewhere else you need to be? I got all day. Let's do it. 7 hours right now. Deltas of covered calls. Listen. I think our audience would actually probably be down for that. Unfortunately, Mr. Dan, that music means we have come to the end of another epic sojourn through the world of options. And today's episode, listeners, deeper dive, I should say, really into Delta. In particular, the misperception that Delta is the pure probability of an option expiring in the money. It's a good shorthand, and you should take it as that. If you want the rules of thumb, remember, approximately 50 Delta for at the money, closing in on 100 as you get farther in the money, closing in on 0 as you get further out of the money. So if you see an option with a 35 Delta, you know instantly it's out of the money, right? You can just do that math. If you see a 76 Delta, then of course you know that option is in the money, and you start to get a little bit more familiar with these metrics. You can kind of use those as a shorthand in your trading. And again, go back into the archives, including episode 128, episode 112, episode 76, and episode 65. We did deeper dives into Delta on those episodes as well. If you want more Delta in your lives, we got you covered. And Dan, if folks want to hit you up about the aforementioned 7-hour options covered call seminar, or anything else you got cooking over there, where should they go? What should they do?
Yep, we love to hear from our listeners here from the show, and you can always hit me up at markettaker.com and just hit the contact us or hit the join free button. And for right now, anyway, we're giving temporarily free access to our chat room. So we'd absolutely love to hear from you. And I'll tell you what, if you go in there today and you click join free, that'll put you on our invite list for a webinar that we're having tomorrow.
There you go. Markettaker.com. 2 T's. Don't forget the second T. Get on over there. You can join in the live chat. If you do it right as you listen to this show, which will be hitting the on-demand shortly today, you can go get in time for Dan's webinar. They always have cool stuff cooking over there. Markettaker.com. Don't forget the second T. And of course, if you're listening on demand, first off, you should have already upgraded to get the full network, because if you did, you already have Options Playbook Radio 401 in your hot little hands. Brian recorded early today, so you're already tasting that delicious morsel, and you're ready for a little bit more Options Bootcamp educational goodness in your ear holes. Back again tomorrow, of course, with TWIFO, the number 2 overall options program, according to, I forgot what site it was, ranking the top best 15 options podcast this week in futures options. That's coming up tomorrow, as well as episode 2 for the week of the Option Block, which was the number 1 overall options podcast. And then, of course, Friday volatility views, noon central, and following after that for all of our secret club folks, Options Oddities. That show, if you're not checking it out, listeners, it's a fun one. We break down a whole bunch of crazy trading, look at unusual activity, do some of our own trades. It's a good time. Learn more at theoptionsinsider.com/secret club. Then we'll see you back here next Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.